Mr. Burr. So listen, hey, we are, and I guess Devin, you got the Instagram thing going as well. Yo, drop some knowledge. That's what we do up here. So, so check
I think
it out,
we should
guys.
apologize, people,
Apologize?
about how I mixed up Pacific Standard.
Oh
and
yeah,
Mountain
go ahead.
Standard.
Way to go.
So guys,
it will never happen again.
Guys, this will never happen again. But I live in Arizona. We don't change our clocks, so we were on Pacific time.
Yep.
And then daylight savings time changed this weekend, so now we're on Mountain time. Or they're with us. I don't know how it works. Everyone just get rid of daylight savings time. It's so much easier when you don't change your clock. So I apologize. I said 11 Pacific time. I guess it's 10 Pacific time.
Yep.
My apologies. But anyways, let's drop some knowledge.
We'll probably still be going at that time, but it's all good. It's all good. So check it out. So we're getting on here. We're going to be doing this video talking about Infinite Banking 101. This is kind of a series I've been doing on my channel for the last couple of weeks, coming on live, answering questions, going through the comment sections in the videos. So the goal here is, if you have any questions, by all means, ask them, engage. And if there's nothing, or like no questions that are live right now, we're going to be going through the comment section in my YouTube channel to, figure it out and just to answer anybody's all the. And it's fun. All the hate.
Yep.
And so this is why I did it. Just so you know, like the mindset. It's not just to educate people, because I mean, obviously that's a huge part of it. But a big part of this is responding to the haters that like to just like drop bombs and just like ghost you, right?
Yeah.
And they feel like they're really brilliant for like making some stupid like whole life insurance is a scam. See ya, like kind of thing, right? Like those guys. And so, so we're going to go through literally comment by comment by comment, because if you know me and you watch this channel, you know that I don't really hide from anything as far as this goes. I respond to everything. I hit everybody head on. And I think that's just the way it needs to be.
For sure.
We need the transparency. And so Devin is here today. We're going to be doing, I figured it'd be fun to have him come on because we're going to be filming some more content as well. But figured rather than me just do this session alone, I'd bring him on and get his take on some comments as well. So it's gonna be fun stuff. So let's just dive right into this. I am going to actually share my screen. This is gonna be fun. So if I share my screen, I can actually go here. Tell you what, let me drag this up into the other there. I'm gonna go that. There we go. Get the comments going. And then what I'll do is I'll get over here. I promise you guys this will make sense in 1 second. We're going to share. And I want to go like that.
Look at that.
Bam.
Guys, everyone here.
I love technology.
You guys can't see everything that we're seeing, but Chris has the craziest setup when it comes to his studio. Like literally there's a monitor here, there's a monitor there, there's like this weird mirror camera thing going on there. There's this huge, like, that camera's probably what, like $4 grand, $5 grand?
Like that.
That's a legit camera. There's some little lever thing. There's all these, like, there is some crazy shit back here. Like, for real.
Yeah, it's good. It's a good time. We just have some fun. So check it out. So the first question, let's get into this. I had a question right here. You can see somebody asked, the 8.4% dividend, is it after fees credited or the entire amount? This is what the account actually gets, I guess is the question. And so this is on a video I did, why you should save your money inside of a whole life insurance policy. Now, when you look at this, this was actually a historical look back. It's the actual average dividend and it was sourced because he asked where somebody else in this video a while ago asked where that statistic was sourced from. It's actually the actual performance of Mass Mutual. Now, here's the deal. That is not the net. That is always a gross number when you look at that dividend rate. And so you have to back out expenses, charges, admin fees, all these different things, right? So let's talk about this a little bit. It's kind of answering that question. This is going to get really technical, and I'm trying to make it not super technical because then it gets not as much fun. But I think this stuff is really important. Anybody that's thinking about buying a properly designed whole life insurance policy, implementing infinite banking, I think this is one of those areas that you really need to understand because there's a lot of companies out there that will market higher dividend rates. Some companies are lower, and then some companies won't play the game, right? They don't declare a dividend, right? They just say, hey, we're going to pay you a dividend, but we're not going to play the game and do what every other company does, literally every other company, where they say we're going to pay you a 6% dividend or a 5.75% dividend or 5.5 or 5.2, depending on the company.
Right.
But the bottom line is whenever a company has a marketed dividend like that, let's call it 6%, just to keep things easy to talk about. So if they market a 6% dividend, that's the gross number, right? So when I say gross versus net, think about it this way. You have gross income and then you have net income, right? So your net income is after all expenses and taxes and all these things, right? Like if you're running a business, and your gross is everything before that. It's just revenue. And so with the 6% number, that's the company's number before they can back out all their expenses and charges and all these things that it costs to run the business. So just because a company says 6% doesn't mean they're paying 6%.
Right.
So I think it's important for people to understand that, because it's going to illustrate as if they're paying 6%,
right?
But it doesn't mean that they're going to pay that. And so what I love is, I've been talking to some people at a company, that they said, hey, listen, we're not gonna play that game. We're gonna give higher guarantees, and we're not gonna declare what our dividend is. We're just gonna say, listen,
One America.
Yep.
Yes.
Yeah. So
I love One America.
They're amazing, and it's because, and listen, it's one of those things. I like to rip on the IUL space a lot, right? Because of the fact that if you go to an IUL, the only guarantee in an IUL is that it's never going to perform the way it's illustrated. That's the only guarantee in an IUL, is it's never going to perform the way it's illustrated.
100%.
Now, I don't think I give enough criticism to whole life insurance on the same thing, right? Because the reality is whole life insurance in a lot of situations isn't going to illustrate exactly, or isn't going to perform exactly as illustrated as well. Now,
I would say it would never perform exactly how it illustrates.
Right, exactly.
On the guaranteed side,
right,
and the non-guaranteed side.
It's usually going to, here's the deal. We have to realize why. This is why it's so important to understand and educate yourself why you are doing what you're doing. If you love infinite banking, if you're thinking about implementing this in your life, it's why it's so important to understand how it actually works and how the policies and the actual performance inside of the policies function, the kind of moving levers, because it's never going to be exactly on the current. There's a current side, a current assumption, which is based on the current dividend scale and all these different things, and then there's an assumed rate, right? Like so when you look at when you take that into consideration, here I'm gonna take off the screen share for a second. So when you look at the current assumption, it's based on the current dividend rates and the guarantees. The bottom line is every whole life policy carrier that we'd ever talk to is always done above and beyond the guarantees. So it's never gonna be as bad as the guarantees, most likely. And then, over the past 40 years, honestly, they performed worse than the current assumption because of the fact dividends have gone down and down and down and down.
Right.
Now, the cool part, and this is why it's so important to understand, is that we're I believe, entering an increasing interest rate environment.
Yep.
So I believe over the next 10 years, your whole life policy has a significant chance of outperforming what you're actually looking at for the first time in generations.
Right.
Which is mind blowing. What do we got going on?
One thing I would just touch on.
Yeah.
Whenever I see this kind of question, I feel like people are missing the point.
Okay.
When you talk about like what you're getting credited and how much you're making with a policy, it's not about that. If you look at that, that's one of the biggest mistakes. You're looking at it as an investment. What's it going to make me? What's it going to do for me?
Yep.
Whole life insurance, infinite banking is not an investment. It is simply a place to store your capital so that you can take back the banking function in your life. Think about this. You go to the bank for whatever you need. We need to finance something: cars, houses, boats, planes, if you're balling like that. But bottom line is you're going to be paying the bank interest. All infinite banking is you're storing your capital in a place that's guaranteed to grow more than it would grow in a bank account. tax-free.
Yep.
How much more that is, that's like,
Yeah.
that doesn't matter. It's gonna grow more. Guaranteed tax-free. Bank accounts
100%.
don't grow tax-free.
Right.
It's gonna be protected against lawsuits and judgments. Bank accounts aren't protected against lawsuits and judgments in most states.
Right.
It's gonna give a tax-free death benefit to your heirs. So it's not a place to become rich. It is a place to store capital and perpetuate wealth over time and to take back the banking function in your life. So what you earn on a whole life policy, it doesn't matter. That's not what it's about, right?
100%. Yeah. I mean, think about it this way. A lot of people look at life insurance, or a lot of agents sell life insurance as an investment.
Yeah, an arbitrage.
An arbitrage. And honestly, like, listen, can you make arbitrage in a life insurance policy? Sure, you can. Eventually. But the bottom line is, you're not making arbitrage immediately inside of one. Nothing good happens on a short-term basis in life, no matter what. There's no free lunches. Nothing happens. You're not gonna have like this magical financial vehicle that's just gonna get you these results with no expectation of you being committed to it from a long-term perspective.
And if you do, there's a ton of risk.
Totally. Well, yeah, exactly.
Ton of risk.
Exactly. Yeah, exactly. Like, you're going to take on risk if you want any kind of like huge upside.
Right.
And that is what it is. So this is when I think it's really important for people to understand that from a long-term perspective, you need to be looking at this as like, what are your goals and objectives? What is your time frame? And we need to then reverse engineer like how you're trying to leverage a policy to help increase your financial efficiency. I always kind of tell people a properly designed whole life insurance policy is the only financial product in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not.
Yep.
Right. Like, and so from that perspective, there's no other financial vehicle that puts you in the driver's seat of the results in your life. And while whole life insurance isn't going to make you wealthy on its own, it might make your family wealthy if something tragic happens. It's a self-completing plan, right?
100%.
So while it's not going to make you wealthy on its own, one of the things I've been talking a lot about lately, and I've been writing my new book, is the 4 F's of life, right? And so it's faith, family, fitness, and finances. Okay. So, and I've been talking about this a lot because I think it's so important. It's with our faith, if we want to grow, can you get your pastor to read your Bible and help you grow in your faith and your relationship with God? No, you can't. As a husband, as a father in your family, can you have your best friend or family take your role and make you better as a husband or a father? No, you got to show up and do the work.
Right.
With your fitness, i.e. health, I just wanted an F. Like, can you have other people eat healthy for you and work out for you and do all these? No, you have to take accountability.
Yeah.
And so we know we can't outsource the success in our life. And so what I've realized in writing my book that I'm doing now is that when you utilize whole life as a cornerstone foundational asset in your life and you implement infinite banking, it is the only financial strategy that forces you to become who you need to become to live the life that you want to live. Think about it. Like, that's huge, right? Because finances, if we think about it, more stress is caused because of financial stress. Fair enough?
Yep.
More divorces are caused because of financial stress.
Yep.
More health issues are caused because of financial stress, because if stress causes disease and finances are the number one causer of stress.
Yep.
Like, so what I love about what we do and what I've been realizing is like what we do is we really help people in all the most important areas of their life, even if we're not necessarily having that be the foundational reason that we're doing. You know what I mean? Like, somebody might not open up and be like, hey, I want you to help me with my marriage, like, but at the same time, there's a direct correlation, right? Because it's going to force you to become who you need to be to live that life that you want to live. And when you look at it, you got to think long-term and you got to be willing to put the work in, because the whole idea of, going to school, getting a job, putting your money in 401k, giving your money to a money manager and having it kind of grow, it's like, not going to work. That system is broken. And I call it this way. I call it a failed financial experiment. And a lot of people that look at 401ks, IRAs, Roth IRAs, they look at those as their traditional vehicles to lean on and leverage. But guys, they're just an experiment, because we're hitting now the first generation that has gone through a whole working career
with 401ks,
with 401ks, IRAs, and Roths, right? And been able to hit retirement utilizing those vehicles as the foundational, vehicles.
Because it came
1980, like 79
Yeah.
is when, but like 1981, 82 is when 401ks started getting popular. Roth IRAs weren't created until 1997, 98, right? Like, so you look at these vehicles and everybody goes, oh, these are just like the traditional vehicles. I'm older than both of them, like I don't know what to say to that. Like, and look at how many people are failing right now.
Yep.
And
you think whole life has been around. I think the first life insurance policies were written back in the 1700s.
They were
1790s.
Yeah, but
1780s.
But think about it this way: all of the companies that are in existence, like that, we look at right now,
100 plus years.
We're looking at 100 to 120 plus years, and you're looking like 1840 is kind of like the oldest of the modern mutual companies all the way till today. So when you look at 1840, that's 180 years. Like
most stable companies in the nation.
Yeah.
So at its core, guys, just think of infinite banking like this. Really, all it is you are basically financing everything in life. You're either borrowing from someone else or you're paying with your money and giving up the ability for that money to grow to earn you interest. So you're financing everything. You go buy a car with cash, you're financing it because you're giving up the interest that cash could have earned you. You borrow from the bank, you're paying the bank interest, and you're giving up the payments that the money could earn you interest with, right?
Yeah.
So you're financing everything in life. Infinite banking is basically just building a warehouse of capital that'll never stop growing, guaranteed, tax-free, that you can now finance everything in your life. The goal should be able to finance 100% of your needs in life. I'm not there yet. I'm sure you're not there yet.
No.
It takes time. Like, I can't go finance every house that I buy from my policies because I don't have enough cash value yet. But I'm only 37. By the time I'm in my 50s, because I have so many policies, because I'm putting so much to them, because they never stop compounding and growing, I will eventually be able to finance everything from my policies, not borrow from the bank, borrow from my policy, pay myself what I would have paid the bank. So now I'm getting that interest.
Yeah.
And it's from a storehouse of capital that never stops growing at the exact same time. That's what it is. You're literally just trying to take back the banking function in your life. It's not about the growth rate. It's not about how much you make in it. It's about having control of your capital.
It's about volume,
More you put in, more you can use.
The more you put in, the more you use. And listen, one of the biggest challenges, let's see if I can get this on here. So like most people, this is what they do. Let's say they earn 100,000. Sean, can you see this in the monitor? Yeah. Okay. So if you do 100,000, most people are taught to take 10%, which is 10,000, right? So and so you got 90,000 left after that, right? So what are people told? They're told to take this 10,000 and go take risk, right? And go invest it, right? So what do you want to chase in that 10,000? Maybe 10%? Do you realize how much risk you have to take to be able to get 10% return? So what are you doing? You're taking that 10% to try to earn what, $1,000?
$1,000.
Like what is that? So what people don't realize is that if we stopped thinking about trying to do this and take a small percentage of our income and take a lot of risk, which by the way, the more risk you take, the higher your chances of losses, right? Like, so that's one of the things that I think a lot of people don't understand is we've all bought into this idea of the younger you are, the more risk you could take. It's like the younger you are, the less risk you have to take.
Sure.
Right. And so, but think about this. Now we're thinking about trying to take a lot of risk, chasing this 10% on this small percentage. Well, this $90,000 that we have left in our lifestyle, my question to everybody watching this right now is, how much inefficiency do you have in your life? Right? If I were to really challenge you, not you, but like most people, and because you talk to a lot of people like I do, obviously, right? That people that call you are looking for help and this stuff. On average of the person you said, if you were to ask the people that you got on the phone with and said, hey, do you think you have 1% inefficiency in your financial life? What do you think they'd say?
Oh, they would say much, much higher.
4, 5, 6, 10.
If they knew the definition of what inefficiency is.
Sure. But let's just talk like real surface level without even getting deep into like what we know, right? surface level, how much inefficiency do you think, and because I want to keep this real simple, how much inefficiency do you think most people believe that they have? Like if I were to say, if you were just an average person and said, hey, like how much inefficiency do you think you have in your life?
I think they would say less than they actually know they have.
Okay, but
so let's say 10%.
10%. Okay, so here's the deal. If you had, like, that's a big number. I would say most people wouldn't even say they had that much.
Because they think they're in better position.
They think they're in better position. Let's just call it 5% though, okay? So think about this. If at 5%, if I could help you find 5% inefficiency of this $90,000, that's $4,500, right? So this is why when people talk about infinite banking, it's not about the rate of return. It's not about the investment. It's about the system that's going to help you operate more efficiently. And if we can do this and recapture this 5% of inefficiency, flow it into a place, this is the equivalent of a 45% return on this 10,000 without taking this risk, right? So it's going to help you get where you want to get on a guaranteed basis with no risk. And it's going to put you in position. So now as the market goes through cycles, right? Because the market goes through cycles, you know, these cycles right here where we're in this market right now where things are getting pretty bad potentially, right? We're kind of in one of those spots, I believe. If you believe that as well, this is something to really consider. And so these times, if you go about this, right, when you put your money in a 401k utilizing this kind of system, you lose control of that. So what's the opportunity cost to not having access to that capital?
Right.
It's huge. But when you do this, not only are you having more control, you're saving before you invest. And when you invest, you get to invest at the right times, right?
Yep.
Like you can get to invest when the opportunity is better. And there, you can kind of create this asymmetric risk because when you're buying low, the best way to make money is to buy low, sell high, right? So why when we're near the tops of all these markets and all these levels, why would you ever put all your money into something in that scenario? If we know the market is cyclical and we know that it's not linear, meaning cyclical, meaning it goes up and it comes down, it goes up and it comes down, right? So if we know that this is going to happen 5-6 times during our working careers, why are we not preparing for it?
Right.
Like that's what I just like, when I think about infinite banking, it's not like, I don't know, it gets overly technicalized in my opinion, right? It's like, we need to think about like, how does it fit into our life? How are we going to leverage it? How are we going to use it? And how is it going to help us solve our needs of getting where we want to go and having control of our money?
And really, it's that simple. It really is that simple. Like totally. that was a lot that you said, a lot that I've said. But think about this. It's really that simple, guys. If you look at $90,000, right, and then you have $10,000 to risk, to invest, to save. Yeah. You're going to take a lot of risk if you take this 10,000 and try to make a high rate of return, right? However, inefficiencies, so 4,500, when Chris talks about inefficiencies, what that means is money leaving you and your family forever. Yeah. So interest to other people, banks, lenders, that's what the inefficiencies are. Yep. Look at your mortgage statement. 86% of every dollar spent goes to the interest in the first 7 to 8 years. Yep. The bank knows you're not going to keep that loan for 7 to 8 years. You're going to sell. You're going to refinance because you need cash out. Car loans, look how much interest goes to that. The average person does not pay a car loan off. They trade the car in. And if you look at the actual numbers, 21 cents out of every dollar on average goes to interest. Those are inefficiencies.
So let's talk about that real quick. Those are inefficiencies. And so like a lot of people, so I'd be curious. I'm curious to hear your feedback on this because we've never really talked about this, guys. So this is new. This is going to be fun. So if we talk about that though, let's say you have a $500,000 house. Okay.
$500,000 house.
$500,000 house. And somebody, you need to put, let's just say for the sake of, you got to put 20% down on it so you could get a $400,000 mortgage, right? You got to put $100,000 down, right? So it's a $100,000 down payment. So you gotta get this, right? Or a lot of people would say, pay cash for it, right? What do you think? Like, what is your? I don't want to set you up here to like trap you or anything, but like, I'm curious because a lot of people would say either pay cash or finance completely, you know. And I guess I'll kind of come at it from what I believe, so I don't like set you up for anything,
for failure,
you know, for failure. Like, but here's the deal: is that this 400,000, I believe, when we look at these numbers, what we're doing over here, we're saving, right? We're saving, we're not investing,
right?
But we're increasing financial efficiency,
right?
So when is this house paid off? This house is paid off. A lot of people would say, I want to pay this because we have to understand opportunity cost, because you just said 86% of expenses are going to on this $400,000 mortgage. So if we did a 6% mortgage on this over a 30-year period, you're probably going to pay, let's just say $900,000, right, on that mortgage. So people are being like, well, that's $500,000 of interest, right? So the idea is I want to pay cash for this to avoid that $500,000.
I know where you're
expenses,
going with this,
right?
I know where you're going with this.
And so with that said,
so what would I do?
Yeah, what would you do?
So one, guys, I would never, ever pay cash for a property of my cash. Let's put it that way. I would never use my capital.
Right.
Because if I put $400,000 and I don't have a mortgage payment, that's the benefit of paying cash. You don't have a payment. You don't have interest. How much could I make over 30 years with $400,000? I could make a hell of a lot more than the difference, $500,000. To that point, I would never put 20% down if I didn't have to.
Right.
You can put as little, if you're doing an FHA, 3.25 or 3.5. If you're a veteran, you can put 0 down.
Yeah, you just got to look at what PMI costs are and how that plays into everything.
Even with that, I used to do mortgages, guys, for a long time, 13 years before I got into real estate. Bottom line is, you never want to pay down simple interest debt if it means you're not putting money into compound interest.
Right.
You want money to compound because simple interest debt works very easily. As you pay this balance down, your interest is calculated on a smaller balance every time. So the amount of interest you pay goes down every single payment.
Like an amortized payment. Bingo.
Goes down every time.
Yep.
So every payment you pay less and less interest. Compound interest, your balance goes up. So you earn more and more interest.
Yep.
You never want to, like, I don't pay extra on my mortgages. I pay literally down to the penny, the minimum. Because if I was to pay extra, let's say it pays it off 5 years sooner. I saved this much. How much could I have earned if I would have put that same amount towards compound interest? More than what I saved. It's just math.
Well, so it's funny you say that, because I always kind of tell people math and money are two different things, right? So I could show you here how, if you're, and the numbers may be a little off, but I could say you could have a 7% mortgage, right? And I could show you how, okay, if this, and once again, we haven't done the exact numbers, so don't go getting out your calculator and being critical, because it's the principle we're talking about here in general. And this is going to be a ballpark, result here. But $400,000 to $900,000, that's $500,000 of interest, assuming a 7% loan, ballpark, once again, for round number's sake. I could show you how probably over that 30-year period, where if you could earn 4.5%, you're going to earn that $400,000 is going to grow to more than 900,000 over a 30-year period, right? So this is where I say math and money are different, because a lot of people go, well, if I can't earn at least what I'm paying, well, then it doesn't make sense, right? But there's a difference between compounding and reducing amortization, right? Like, that's what people need to get. And when you start to realize that, everything changes. When you understand that concept with the concept of opportunity cost, which is simply put, when I spend that $400,000, assuming I could pay cash, not only do I lose that $400,000, I lose what that $400,000 could earn for me forever. So actually, let's do a quick number here. I just want to kind of ballpark it. I love this. I'm a nerd. Let's see here. So let's go 72 divided by 4.5 every 16 years. So in a 32-year period, because just to keep number, like, once again, using the rule of 72 with a 4.5% assumption, that means that 400,000 is going to double every 16 years. So that's going to go to 800, go to 1.6 million. Okay.
Right.
So in 32 years, granted, we said like a 30-year period, but in a 32-year period, that's going to be 1.6 million, because in 16 years, it'll be 800, and that 800 will turn to 1.6 million in 32 years. So basically, I would say, if that's not worth, at least, if your house isn't worth at least 1.4 million at the end of the 30 years, or if it is, you could have 1.4 million in this account. You basically had about a $500,000 mistake.
Yeah.
By paying cash for it. People don't realize that. And plus you get the tax benefits and all that other stuff.
Here's the cool part, though. If you guys use infinite banking how it should be used, which is, again, getting a storehouse of capital that you can finance things in your life through. Think about this. If you have $500,000 in cash value, you could take the 500, buy the house cash, take a loan against your policy, buy the house cash. Your 500 grand is still going to compound over the 30 years, act just like the lender would, and charge an interest rate, 7%, let's say, on 30-year amortization. So now over the time frame, you're getting that $500,000 in interest, plus the money you used to actually buy the house never stopped compounding.
Right. Totally. It's amazing.
You just have to get to that point by putting money in.
Well, you know what's also crazy is like 10 months ago, 12 months ago, we were talking about, like, I was talking a lot about, I don't know what you were doing, but like I was talking a lot about utilizing cash value lines of credit, right? Like, because you could go get a 2% cash value line of credit because interest rates were so low. So you could like bake in arbitrage. That was like, I was doing legitimately, it was available, right? Because you could go, you know, earn 4%, 3% after all fees, and genuinely have arbitrage because of the line of credit. The problem is now these lines of credit are 5.5, you know? You know, so now the line of credit doesn't work, right? The policy, all of a sudden, the value in the policy is like One America right now. I could tell you their loan rate is 4.08%. And what's crazy is this is all tied to the Moody's.
And it like rarely changes.
Well, not only that, so I just found this out. Like, this is why I'm loving this company, their transparency, is that the 4.08 can only go up by 50 bips per year.
So for you guys, right? So you guys know it's half point.
So next year, worst case scenario, the loan rates are only going to be 4.58% from this. Now, let's assume mortgage rates and all these other assets go to 9%. Which is not outside of the realm of possibility in the next 12 months. Right. If you can put your money in a place where you know you can lock in this kind of cheap money when the rest of the world is doing this, when we talk about arbitrage, if you really want to take it second level, get sexy, you could buy bonds and get a guaranteed 7, 6, whatever it is, and pay 4.58. You can't do it yet, but you got to be willing to plant the tree to be able to like take advantage of the harvest later, right? Like, we are going to this increasing interest rate environment. We're already in it, let's face it. And as these numbers get higher, the interest rate, I think it's key to know on the way down, life insurance companies benefit because they reduce slower, and on the way up, they're gonna increase slower as well. So the rates are going to increase slower. So that will be able to create how you can leverage them as a tool. It is just a little bit inverse, but they still have a benefit. Does that make sense?
Guys, that's technically exactly what I do right now. I'm not actively investing in real estate because it's too risky. Like, buying anything right now doesn't make sense. It's just too high, and I don't know what's going to happen. Yes. So all I'm doing, guys, is I used to do cash value lines of credits. For those of you guys that don't know what that is, you go to a bank. Not every bank does it, but they'll use your cash value as collateral. And they'll do a collateral assignment, meaning they actually have all your cash value as collateral to give you a line of credit. So now you're borrowing from the bank. You're not borrowing from your insurance policy. It used to make sense. I had all of mine under one umbrella on a line of credit. I was borrowing at 2%. That makes all the sense in the world. It's up to 5.5 now, so it doesn't make sense. So I canceled it. If I can borrow at this, which I am, because I have my policies through One America, and then I can borrow against it, I'm going to pay this to control that money. And then I lend it out on real estate deals. I lend out on deals where I'm in first lien position. So if people stop making the payments, I get the house. So I lend at 12, 15, 18% interest.
You're paying.
And I'm controlling the money at this. So I'm keeping the spread while my money keeps compounding at in the policy at the exact same time.
It's amazing.
That's simple.
I mean, it's phenomenal. So I got a couple questions here I want to make sure we get to, because we just go on these rants and sometimes I forget to look.
This is true. Sean, you just gotta let us know, bro. Get to the next question.
Yeah, exactly. Just snap us.
We're over here.
Snap us, bro. Snap us.
Throw something at me.
Yeah, exactly. And if you want to check your comments there and question, I don't know what you have going on, but I'm happy. So can you do these with an IRA conversion? No. So like you can't utilize an IRA conversion with these because of the fact that remember, an IRA is just a tax code. It's basically the wrapper and the tax benefits associated with it. And so completely different thing. If you wanted to use IRA money, you just have to make a decision. Like a lot of people ask me, like, should I convert my IRA to do this? And I never like to tell anybody what they should and shouldn't do in that scenario. I always, the thing I kind of like stick with in that environment is saying, is your money in alignment with your values and your beliefs? And from that context, what it really comes down to is you have to ask yourself, what do you believe about the world? Where do you believe taxes are going? What do you think about the debt, the unfunded liabilities, and just the overall general direction? And my belief is I can't tell you what you should do. I can tell you what I would do and why I don't put my money in an IRA, because of the fact that when anybody puts their money in an IRA, you're basically in business with the government. The government is your business partner. They're your investment partner. And they're the worst partner of all time because they have complete control of your money and your account. And all they have to do is like literally sign a document, raise tax rates, and they basically take a portion of your money at a higher rate. And when you realize that we're at the longest low-term rate of taxes that we've ever had, right? Ever had since the institution of the Federal Reserve, and you realize that we have more debt, interest rates are going up, there's more stress, there's more unfunded liabilities, and that taxes that have to go up to be able to support the stress that's going to come on the economy. I don't want my money in a place where I don't have control of the results. That's really what it comes down to.
I want to know what I'm paying taxes on.
Exactly. I'd rather just pay it, get it out of the way. And my belief is like, if I had money there, once again, I'm not saying this is for you, but for me, I would be willing to pay the 10% penalty just as a control fee to regain that control. Because listen, if I've got 100 grand and I got to pay a $10,000 penalty, all it does is in a year take the government to sign a bill and say your tax rate's up 10%, and now you have to pay more in taxes. You lost that 10 grand anyway, that 10% anyway, and you still don't control your money.
Let me see this. I'm going to show you guys again. I'm the same way. I don't want to tell you what you should do.
Yeah.
I'll just tell you what I did.
Yeah.
All right.
Perfect.
So when I left my my job, guys, I had a old 401k with 175,000, give or take. Okay. There was 175 grand in a 401k. So I liquidated it because I knew like, hey, I'm going to pay the taxes now, not later. I know taxes are probably going to go up. They're not going to go down. So I liquidated it, paid the penalty. After penalty and paying taxes, I was left with $125,000, give or take. All right. So I took a $50,000 hit, right? Had to pay my taxes, had to pay the penalty.
Yep.
What I did is I put this 125 into a properly structured policy. Within 30 days, it actually took about a week, I was able to get right at about 109,000 bucks. All right. So I took a loan against my 125. The 125 keeps compounding and growing.
Correct.
I took the 109, put it into a real estate deal. So this money went into real estate. It was a flip. Took about 4 months to finish the flip. In 4 months, I made all of this back plus my profit, which was about 60,000 bucks. So I got 169 back. What did I do? I took the 169, paid back the 109. I'm left with about 60 grand.
Yep.
I've already made back more than what I lost. And how much is this going to compound and grow over the next 30 years?
Totally.
And how much can I make with having access to all of this compounding and growing? That's what control does, guys.
It's so key because what's not realized or what's not and you'll hear us say this all the time, control is the most important element. Opportunity cost and control. And listen, you can't, when people say, what's the rate of return in a whole life policy? How good are you is really my answer. Because it's not a matter of what's the rate of return. Life insurance companies do one thing better than any other financial institution in the world. They are going to preserve the purchasing power of your capital, period. Meaning that's a sexy way of saying, maybe not so sexy, it's sexy to me, of saying that they're going to beat inflation from a long-term perspective. Now, are they going to beat it every year? Are they going to beat it this year? No, probably not. Definitely not this year, right? But over the long term, they will beat inflation. They will preserve the purchasing power of your money. Now, with that, now it comes down to control. And what is the value of control? Depends on how good you are. Depends on how connected you are. Depends on how much you've invested in yourself and your skills and your knowledge and how good you are at finding opportunity. Like we're doing stuff in the Dominican right now.
How good you are using the money outside the policy.
Exactly. But that's you. And that's where at the beginning of this video, if you were here, I was saying, I love this because it forces you to become more so you can accomplish. Like, how do you expect to achieve a life beyond where you are right now if you're not going to grow into that? right? Like, so there's not another financial strategy out there that forces you to do that. And I know that overwhelms some people and they're like, oh, I don't want to be active. Well, have fun being mediocre the rest of your life. Am I wrong?
Do you have a calculator? This will prove your point.
Okay.
So calculate the rate of return I made on this investment. I took 109 and I made 169. So $60,000, but took me 109,000 to make 60 grand.
Yeah, it's a 55% rate of return.
So most people would think on this deal, I made 55%.
Yeah.
It's not true.
Right.
I made in this policy, this was Mass Mutual, that year it compounded at about 6%. So you add 6% to my rate of return, which was 55?
6%. Yeah, to the 55.
So let's say I made 61% rate of return.
Yep.
Most people would think that's what I made. It's not true because my money is not being used. I'm borrowing money.
Right.
So I'm borrowing at 5%
Leverage.
interest to go make 61%. So what's that rate of return?
5 divided by 61. That's a lot. 5 divided by 61. 81%.
810.
810. Yeah, 810.
So this deal, guys, I made a 810% rate of return simply because I used leverage. I used other people's money, the insurance company's money.
Totally. And when you look at that, I mean, you start looking at that, it can get technical for a lot of people. And so, and it's, yes, I think it's just the important part here though, is just the control component of it. Right. Like, and so the numbers are great. Like when we start throwing around like 800% returns, like I just get a little worried.
Yeah.
Like,
that would not happen if I did not know what to do with this money.
Right.
If I took this and put it into a bad real estate deal and I lost money on that deal.
Right.
I'm no longer making 810.
Right. And remember, it's not 810 on the 109. It's 810 on the leverage of what you're actually using, what it's actually costing you, and what the return is. Right. Like, so that's really like, because remember when you're borrowing at that 109, there's a cost to that money. And so he's talking about the return is, what is the return on the cost of that money? Right. Effectively.
So it cost me 5% to borrow that.
Right.
So over a year's time, that's what, like $6,000.
Right.
It only took me 4 months.
And that's why it's called infinite banking, right? Because if you think about what do banks do, when you put your money in a bank, they pay you a small percentage to have your money in there. That money is now a liability to the bank because it's not theirs. They know they're obligated to give it back to you. But what do? They can then leverage it as a tier 1 asset to go leverage it out and give somebody else a loan. And then they may give you 1%, actually probably less, but let's say right now they're giving you 1% and they're giving somebody else, let's say they're charging somebody 8%, well, that spread, that's a 800% return.
Yep.
Right. Like, just to keep numbers really simple, that's how the bank makes their money. And that's what Devin's talking about when we're talking about there's a cost. That 1% for you having your money on deposit with the bank is the cost to the bank. And then whatever they loan it at is their profit, right? The spread between the two is the profit. That's the margin. And so infinite banking, that's what you're talking about. Having the control of this is the key. There's going to be a cost. Now, to that point, you always want to be able to find the best cost. You want to be able to do things as long as that cost doesn't put you in a position where you give up control, right? Like, and so there's all that to kind of take into consideration. I have a real estate portfolio. Should I pay my real estate taxes with my new whole life policy? I know a lot of people that do that. And I think it's, you start getting into that. I'm not a big believer that there's a should or shouldn't. I think it's a case-by-case basis. I'd be curious to hear what you do. But like, I think the answer is yes, if you're really good at managing it, right? Like the more active you want to be with utilizing your whole life policy for anything of that nature, you just got to make sure you're really on the ball with managing it.
Yeah, I agree. That's one of my strengths is managing like numbers and where everything's at. I've got 9 policies. I have like 15 different bank accounts. Yeah. So different properties have different bank accounts. I'm really good at knowing where numbers are at. Yep. Money moving in this account, out of this account. Wife will be like, what in the world's going on? I'm like, I've got it under control. Trust me. So I'm good at it. So I do it. Anything that I buy, I use for my policy. So when I pay the tax bill on my houses, I do not put it in escrow because all you're doing is you're letting the escrow company make interest off holding your money. Makes no sense. I'd rather hold on to that money and be able to make money off of it. Sure. So when the tax bill comes, let's say it's $5,000. So $5,000. So what I would do is I would, again, since I'm the bank, I dictate the terms. So I could take a loan for $5,000 and pay myself back 8% interest, 7% interest, 10%, whatever I want. And what do most people do when they get a loan? They worry about the payment, right? So if they want a lower payment, what do? They extend the term.
Yep.
Which the longer your term, the more interest you end up paying to the lender.
Sure.
I could care less because that interest is coming to me.
Right.
So what I'll do on $5,000 is, let's say I lend it at 8% interest. I'll do it for 60 months. Have the payment real low. And since I'm the lender, I can pay this off at any time if I have a lump sum of money come in and I want to have more money in my policy, whatever the case may be. The cool thing about infinite banking is literally you are in total control. If I take $5,000 as a loan for my policy, the insurance company, they're never going to say, Devin, you have a payment you got to make.
Right.
You owe us this much money. Right. Come on, pay up. They'll never do that.
I do want to say this. That is true as long as you're A, making your premium payments, and B, the policy is mature enough. Like a lot of times people will try to leverage. Like the example, the only thing I want to warn people at, if Devin went in with 125 of cash value, borrowed 109, and then never made an interest payment on that, he could run into issues.
Right.
So I just want to make sure that that's totally transparent.
So what I do, guys, is I don't get into all of the nitty gritty of what I do because then it just gets confusing. I try to keep it surface level.
Sure.
What I did on this deal, guys, is 109. I didn't just take it and put it in the real estate deal. I took the 109 and I lent it to my LLC. So I create a note between Devin Burr and my LLC, Onyx Investment Group. Now, Onyx Investment Group has a liability for interest-only payments back to me. So those payments, I do 15% interest. So I have 15% interest of the 109 coming back to me. That just goes back into my policy to replenish the cash value. This 15 also comes off of my tax bill.
Yeah, so that tax expense, this expense is written off as a
business expense.
Business expense.
It just goes to repay the loan. So,
but
I don't talk about that usually because then it's just another layer of things for people to understand.
Yeah. So there's a lot of layers that go into that because at the end of the day, the insurance company is charging you, let's just call it 4%, right? And if you're doing this, actually, I'm curious how you handle this because like if you have a trust and stuff, like because there's the 15, if you're writing that off -4, that's 11%. That's got to be claimed as income somewhere.
On my personal side.
But it is on your personal side.
Right.
And if you have it done through a trust or a foundation or whatever, you can run it all through there and then you can do different things.
So yeah, guys,
like there's a whole level to it.
Yes.
So just know that when like there's a lot of when you look at this, you could look at this and be like, all right, the math doesn't add up. There's a lot of holes, right? This 11%, like it's great that he does this, but what about the taxes? And it, like if anything looks too good to be true, it typically is. So I want to let you know that like this, you're right. Right? Like you're seeing all that. Just know that there's multiple different levels depending on where you are economically, where you're starting from, how creative you get, how if you need to do trusts or foundations or anything to add to this to like take advantage of different layers of protection and benefit and you know just strategy, right? And so all that has to be kind of considered when you're going into this. And Devin does it all, right? Like so like
these are complex things, guys.
Yeah, this is not like the most simple thing, but you grow into it. What did I say before? You got to become who you need to be to get to where you want to go. And if this doesn't make sense to you yet, it's because you're not there yet, right? Like, and so the answer is start off with a basic policy, and you will grow into that. Right. You know what I mean? And so, like, I think that's really, really important to understand. So, anything else on that?
This screen, by the way, is amazing.
Yeah,
it's like the best whiteboard ever.
It is awesome. All right. Somebody said we would never get into business with someone where someone makes the terms of service. Oh yeah, exactly. That is so true. That is so true. Somebody asked earlier, talk about utilizing cash value life insurance and where was it? Somebody asked about crypto. Oh, there it is. Can you talk about infinite banking and crypto? Do you have anything on that?
I do crypto. I'm down a lot. But I'm actually.
But it's not a realized loss, right? You're like,
yes, it's
a long
not realized until I pull the money out.
Yeah.
So I use it more of a long-term play, and I'm
Mhm.
continuing to put money in because it's crazy with money. Think with money, people always real estate. If you're buying real estate, if you're buying crypto, if you're buying any investment, it's the only thing where when things are low, people get scared. If you were
Mhm.
going to buy a car, let's say you got a Ferrari, and all of a sudden it's 50% less, people be like, "I need to buy this Ferrari. It's on
Mhm.
sale."
Yeah.
Investments are on sale when they're lower. So crypto's low. I'm buying into crypto right now every single day, dollar cost averaging.
Yeah.
So eventually, I'm bringing the cost of every coin down. It'll eventually be higher
Yeah.
once it's on the upswing.
Have you done any like tax harvesting or anything like that on the low end when the assets come down, like taking the losses for tax write-offs?
I don't need to
You don't need. Okay.
because I have
yeah.
my foundation.
Yeah.
So I pay
That's good.
zero taxes,
Yeah,
guys, all
That's
legally.
good. That's good. Good to know. So, so the answer on that too, I would say I actually interviewed a guy named Dominic Harabi, who is utilizes his infinite banking policy to do all his crypto stuff, and he's a pretty good player in the crypto space. I would say go check it out on the Life 180 channel, wherever you are. It's a really, really good interview with Dominic, and he kind of walks through, starting at about like the 14-minute mark of the video. He walks through kind of what he does in that, and it's pretty phenomenal. So if you want to look at that, I would say go check it out. I was about to complete a policy form on IUL.
Ooh.
I watch your videos on YouTube. I'm still trying to figure out IUL versus whole life. Oh, this is gonna be fun. All right,
you're gonna have a good time.
All
with this.
right. So here's the deal. I don't want to make. I've got like a 70 video playlist on this topic, so it's a lot. What I'll say to this is, at least in correlation and context of what we've been talking about to this point in time, is the fact that it's all about control, right? So if you want to get into all the numbers and all that stuff on IUL and why I don't believe in IUL, check out my playlist, the Index Universal Life Training playlist on the Life 180 channel. If you want to just keep it simple, like what we've been talking about, is when you're a policyholder with a mutually held whole life insurance company, you're a business partner with the company. You're effectively the equivalent of a shareholder of a publicly traded stock, right? Like you're going to benefit through the participation of a dividend with that company. When you are an IUL policyholder with an insurance company, you are a profit center. You're not a business partner. And when we talk about control, whole life insurance, as soon as you sign on that dotted line, having that whole life insurance policy is a privilege, right?
Yep.
And all the contractual risk is on the insurance company.
Yep.
In an IUL, it's still a privilege to get it because you got to qualify for it, but all the contractual risk is on you.
Yep.
And not the insurance company.
Yep.
You, the policyholder, holds all the contractual risk in an IUL. And that is the fundamental difference,
Yep.
right? And so when it comes down to control, we're not just talking about control of money, even though control of money is important with an IUL because the surrender charges are usually a 10 to 15 year surrender schedule, which means you're not going to have as much liquidity in your policy. They're going to say, hey, this is how much money you have in there. You can't touch it all, but it's there, right? Like and it'll get better and better and better over the years. But the bottom line is hypothetically, yeah, well, it will as long as you keep contributing. It'll get a little better. It won't be as good as they want you to think it will.
Right.
But that's the point, is like over those periods of time, as a surrender schedule gets smaller, typically what happens, and historically every time, is why I created the IUL challenge, the insurance company is going to change the moving parts, i.e. control all the moving levers to make it so it performs worse for you and it is more profitable for them. And that's just happens every single time. And once again, I've got the IUL challenge. I got to get more people like helping to push this, because it's, over 800,000 views now of IUL challenge content, and not one person has been able to show me an IUL that's 10 years old that matched what it said it would do. Didn't even beat it. Greatest bull run of all time. Just matched it. Greatest bull run of all time. If they get upside potential, should have just destroyed.
Yeah.
Right. But it hasn't. And that's why. And so when I look at an IUL, what should, if you ever want to do any of that, it's avoid IUL. That's all I would say. That's just my take. And once again, get into that playlist if you want to dig deeper into it. All right. So yeah, it's still back at the 811%. How? We just explained that. So the 811% is based on what the cost of that money is, right? Like cost of access, and then what the actual return of the 60K is. And so that's where that came from. Set up coaching on foundations of trust. Yeah, our team does. I don't know. Do you
Yep.
guys do it? Yeah. So both of us, whoever you want to work with, reach out. But yeah, we both absolutely do. Have teams that will help with that as well. So yeah, do you have any questions? Anything going on over there?
There's been a ton.
A ton?
Yeah.
Sorry.
There's no way we could get to all
No
of
way.
them now.
we got about 10 minutes, I think, until, let me just check my calendar. I think hold on. No. We're good. I just want to make sure I'm not. Yeah, I have an appointment in 30 minutes that I got to be on. So that'll be about a half hour. We can hop back on later, huh?
Yeah, there's so many here.
We got nothing but time. This is what we do. All right. Any other questions, guys? Let's see here. Let me see. Oh man, there's a lot more here actually that let me just read through this. There's a lot. So somebody asked if we could go over the arbitrage basis points in policy loans on IULs. Why is there so much hate in the life insurance space? That's a great question. Well, so define hate. Do you mean hate from like agents to agents, like IUL to whole life, or do you mean hate like Dave Ramsey to whole life insurance? Like, I mean, like, and life insurance agents to Dave Ramsey. I think I can't speak for everybody else. I can speak for me. With my unique background, I guess, is the former director of business development for the top IUL company. I would say this: my passion. A lot of people take my disdain for IUL as like hate, but it's not. It's like my view of it is like a lot of IUL agents hate me and hate my content and have their head buried in the sand because they don't want to acknowledge like math and reality and history and like what's really happening. I really couldn't care less about all the agents watching this that are offended by my topics and don't agree with it and don't see it yet. My guess is they haven't been in the industry long enough to really realize the truth. The reason I do what I do is because to me, it's about truth. It's about sharing my background, my story, my truth, what I know is going to happen with these IULs. That's why I'm offering $1,000 to somebody that could just prove it to me. Yeah. Like nobody's been able to do it because it doesn't happen, right? Like, yeah. And if they're sold as this huge, awesome vehicle, to me, IULs are the most misrepresented product, and they steal and they lie and they mislead and they take all the good parts of whole life and they manipulate and they twist and they tell half truths and they do all these things. And so for me, why is there hate? I don't look at it necessarily as hate. I just look at it as I am passionately for helping people in their personal finances. And I'm passionate about what whole life can do for people and families and helping you get where you want to go from a generational perspective on a guaranteed basis. As soon as you start bringing IUL into the conversation, the risk on that and when people buy them, they think that they're safe and they're anything but that. And so to me, it's not that I hate IUL because there are places that IUL work, and I've done videos on that now, but they just don't work the way that they're sold. And so from that perspective, that's why I wouldn't say it's hate. I wouldn't say that it's hate. I would just say, it's just truth, and transparency. As an agent, we have a huge responsibility to not only help them up the mountain of retirement, but down the mountain as well. Yeah, I mean, like, gosh, that is such a good comment. Like the goal when you climb a mountain isn't to get to the top, it's to get back down safely, right? True. And so when we get to retirement, people's greatest fear right now is running out of money in retirement, right? They're more scared of running out of money than they are death. And Like that's a pretty scary. Is it possible to exchange the bad policy IUL for a good whole life one? So the answer is yeah, you can always 1035 exchange an IUL, but the problem is you got to see, based on where you are, what the surrender charges are, how long you've been in the policy. And a lot of times you gotta kind of make a choice. And I'm a big believer, it doesn't ever make sense to throw good money after bad, right? Like, so sometimes you gotta come to the acknowledgement that you made a tough decision or an uneducated decision. And so like there are ways to do it. If you want somebody to look at your policy, my team does that. I'm sure Devin's team does as well. You could reach out. There are links down in the description. You can go connect and go from there. Let's see here. Yeah, there is hate. What do I think about New York Life whole life policies? Once again, it's not the policies. I think New York Life is a good company. I mean, they're a big four company. They're massive. They've got their financials are phenomenal. The policies are only as good as the agent designing them. I mean, that's it, right? Like,
I think New York Life is direct recognition.
I believe
right?
So. Yeah.
So difference between direct and non-direct guys, direct recognition means when you take a policy loan, it affects your dividends. So you don't earn as much because it's only based on what's left over. Non-direct is really what's best for infinite banking, because when you take a policy loan, it doesn't affect your dividends, how much you're earning, all that stuff. So I don't think New York Life is a great company for infinite banking. Great insurance company if you're getting the death benefit. Great.
Yeah, New York Life and Northwestern Mutual kind of fall in that same.
Great companies for the death benefit.
And most agents at New York Life and Northwestern, they're not taught to do this because that's not what the company wants you to focus on. Right. Like that's not what the companies are training their agents to do. And any agent that has learned it typically has to do it through a third-party training resource, and then in that process has decided to kind of go a different direction.
To the point about hate, I think it's important we touch on this. When people hate, not just from agent to agent, but like consumers, like the average person, I hear all the time, it's a scam. Life insurance is a scam. Infinite banking is a scam. I think it's because people are thinking about normal whole life. If you think about normal whole life, not designed for the cash value, designed for the death benefit, you put money in, let's say $5,000 per year. Of that 5,000, the agent is going to make the first year the bulk of that. That's why you don't traditional policy. So it's very, very lucrative for an agent, and you're not going to build cash value for a very long time, because the way they are built, 5,000 a year would be base premium.
Right. So you're looking at like 12 to 15 years of a break-even point.
And the base premium is what pays for the death benefit. So the bigger the base premium, the bigger the death benefit. That's how most people structure policies, for the death benefit. That's not what we're talking about. We're talking about lowering this base premium. So if I was to structure a policy and someone wanted to put in $5,000 a year, I would make the base premium on this 30% of it, something like that. So
something of that nature.
30% of this would be base, and then 70% would be what's called paid up additions. Paid up additions is basically prepaying for extra death benefit that doesn't have a cost. So there's not really hardly any commissions on this. I'd basically be giving up 70% of my commission so that you can have cash value. Paid up additions accelerates the cash value early in the policy. Base premium accelerates the cash value later in the policy. So you've really just got to determine what you want. Do you want immediate cash value, low base premium? Are you looking for long-term growth, higher base premium? But the whole idea that people get bent out of shape about is it's a scam. It's all for the agent. It's because agents don't know how to structure these. They're not taught how to structure them like this.
They're 2% of agents know how to do this.
Yeah, they're taught to structure it like a regular policy. And think about this. If you owned an insurance company, would you teach your agents how to make less money? These policies, infinite banking policies, make the agent less money. Would you do that? No, because they're going to go somewhere else where they can make more money.
And that's where when you look at companies like New York Life and Northwestern Mutual and, you know, companies of that nature, I don't need to list them all, but like when you look at those career channel companies,
Yeah.
that's typically, it's not that it can't be done. It's just, it's not the culture,
Right.
right? And it typically, in order to do infinite banking and kind of do what Devin's talking about, you're going to be talking to an agent that functions more on the independent channel.
Yep.
Like, you know, there, we don't, I can speak, and I know you're the same way, you know, like we work with a multitude of companies because once again, I mean, this 5,000 a year that Devin's talking about, like this policy, the 30, the 70, all these variables will be based on what your personal situation is and what your objectives are. And designing the policy has always got to be customized, and it's only as good as the agent is you know, at learning what your needs and objectives, desires, you know, some of the risks that may be involved for you. You got to understand all that and design it to make sure that it's got the upside, but it's got the downside protection as well, that makes sure that you're not overly exposed. Because I'm a big believer. I make all my decisions like, what's the upside? What's the downside? Can I live with the downside?
Yeah.
And if the answer is no to I can't live with the downside, then I don't do it. And that's a big reason. If that resonates with you, that's why I don't like IUL, right? Like, because the downside is far too great.
Right.
And so, so somebody asked, what if the bank offers 0% loan? Is it still worth paying the whole life? Oh,
Yes, absolutely.
Say that again.
Absolutely.
Elaborate.
So the reason why it would still make sense. I just had this question yesterday. One of my clients actually asked, he was putting floors in his house. It was going to be $12,000.
Yeah.
And I told him, I was like, look, you're going to pay the bank to borrow that 12 grand, right? So why pay them? Just borrow from your policy, pay your policy back that interest, whatever the payments would have been, whatever the term is going to be. You'll end up getting the interest over that term instead of the bank. And then he said, well, what if they're giving me a 0% interest? Does it still make sense? I'm like, yes, it does. Here's why. If, let's say, I wish I just had like my amortization calculator, but $12,000, let's just say the payment over, these are again, total fictitious numbers. I don't know exactly what this would be, but let's just say over a 3-year period, the payment is, I don't know, $400, right? So if that $400 is going to the bank each and every month with 0 interest, you're not paying them any interest, but you're giving up this $400 every single month. You're giving up the opportunity cost of that money. So how much can that $400 grow into over your lifetime? So what I would do is I would borrow from the policy, the 12 grand to do the floors, and I would personally still pay myself back with interest. But if you want to play the game, just pay yourself back $400 a month. You're going to get all of this back into the policy, and the 12 grand would have never stopped compounding at the exact same time.
Interesting. I think we have a different take on this one.
I love it. I love it. Let's hear it. I love it.
Well, so here's how I look at this. When somebody says 0% interest, let me use my example that I would say is, so I look at my trailer. I had an off-road camper trailer that I had behind my Jeep. And so the trailer MSRP'd for $30,000. Okay. So what I had happen was a guy would say, hey, I'm gonna offer you this at $26,000 plus 0% interest. Okay. So, you know, it's like, that seems like a good deal. Most people would look at this and pounce and be like, oh my gosh, like that's amazing. Because of the fact, once again, this is control and you have to know how to play the game, right? Because of the fact that I came in and I had effectively cash through a banking policy, right? I could go in and I could say, hey, listen, what's the cash price, right? And I got it for $19,990, right? So the point to this is this 0% isn't always 0%, first of all, right? 0%, when you look at a bank, they're a lot of times they'll give you 0%, but they're tacking it somewhere, right? Like, so it's really important to understand that 0% is not equal in all environments. Right. And so it's really easy to fall into that game. 0% is 0%. But for me, what is that worth? The fact that I was able to get this at $19,990, and because I was able to get it so good, and because I got fortunate with the inflationary environment and all that stuff, I was able to cash flow this at 25% plus per year, and then sell it for $2K more than I paid for it after the fact. And I just sold it recently because I saw a bubble coming in the RV market and I wanted to get rid of it. right? And so this made sense for me to do infinite banking, or to use my policy. But let's say all things being equal, if that weren't the case, right? Let's say the 26,000 with 0%, and this is where I'm going to challenge you, okay? And maybe I'm wrong. I don't know. You're the mortgage guy, right? So if I look at 26,000, right, at 0%, well, so whatever you amortize this out just for the principal, I don't know what the payment be. Let's just say it's $500 for the sake of it, right? But there's no interest payment. I'm paying it there. Now, all the while, if I have 26,000 in my banking policy, right, and that 26,000 in my policy is going to be growing, let's just call it plus 4%, okay? It's going to be growing at 4%. So there's always a cost of money, because if I were to borrow against this, I'm gonna pay, let's just call it 4%, call it a wash loan just for the sake of it, for the sake of argument. I'm gonna pay 4%. And so this money, regardless whether I take that loan or not, that's gonna be growing. So I look at it from the perspective of, I'm always gonna take the cheaper money between these two, because this is gonna be a principal, absolutely. The only downside of this, or I guess taking the loan with the bank at 0% is control. Right? It's risk. It's the fact that it's a structured loan. It has a potential negative impact on your credit if you don't make the payment on time. Like, you got to manage it a little differently and stuff like that. But that's where I would say, like, if that's the case, I've got this money growing. I could always take a policy loan to pay that $500 month in, month out if I couldn't afford it. So you just got to kind of manage it. But there's always a cost of money, and this is going to grow at the 4% regardless. You know what I mean? I guess that's how I've always looked at it. And this is, I guess, where I kind of like disagree with some of the pure infinite banking, because like, I understand the idea of like eliminating the bank, right? I kind of come at it from the perspective, I want to eliminate the bank's control of me. So if I have it like this, I'm still in control, because they don't really, like, I'm getting the benefit. Once again, assuming that I'm actually getting this benefit, and it's not like the game that the guy was trying to play with me, give me 26,000 and just charging me an extra 6,000 for that 0%. You know what I mean? So when I look at this, I look at it from the perspective of, there's always a cost of money. And if they'll give me 0, and as long as this 26,000, as long as it really lines out. But once again, it comes down to, when do you know? When do you really know? You only know about the 0% if you have the money in the policy to do the negotiations, right, and to really drive them down to figure out what is the best way to go.
Right.
You know what I'm saying?
I think we have the same view on it. Just
okay.
Yours is more elaborate.
Okay.
Because dude, I would do the same thing too. I would see what the cash price is.
Okay.
Because 100%, it's never 0% interest. There is some, it's baked in somewhere.
Yep.
And then to this point, if I own, let's say this was the actual cash price, 20 grand, right? Mm-hmm. If I've only got 20 grand in my policy, it's not a good use for it.
Sure.
If let's say I've only got 20 grand in my policy, and I have a car loan that I have a 5% interest on, paying that car loan off with that 20 grand it makes sense, but it's not the best use of the policy.
Sure.
If I've got millions in cash value,
right,
the 20 grand doesn't matter.
Sure.
You see what I'm saying?
Yeah.
So it's all case by case, but
I
think we look at it the same way.
Cool. That's good.
It's all the same way, just different views to get to it.
Yeah. And so I would just say, to break what we just said down simply, is you got to look at what's the cost per money. If that's the interest rate in 0, you have to look at, it doesn't mean it's 0 is 0, because this 26, it might actually be 22, right? And they might be plus 4,000, right? Charge 4K charge for interest, or, instead of, they might give you 0, but they're going to bump in 4,000 in extra fees. Yep. So you may be able to get it down to like 22,000 if you were to do your financing. I'll take 22,000 at 4% and do infinite banking. Yep. And it's, and do that all day long. So once again, it's just control. It's just know how to play the game. That's really what it comes down to. And when we talk about what's the return of an infinite banking policy, how good are you?
How good are you at playing the game?
Like, how good are you at playing the game? How good are you at knowing all the moving pieces on the chessboard to be able to play the game? Right. And that's what it comes down to. But that's a big thing. Anyway, the insurance company is getting 3 to 4%. Yeah, it just depends on where you are. Somebody said they're interested in learning what IMO I'm with. We don't technically work together. So the funniest part about our relationship is we're kind of competitors.
Yeah.
But like we refuse to operate from a scarcity mindset. We know and believe that the world just needs this stuff. So we live near each other. We think, make the pie bigger. Don't fight over business. Like have an abundance mindset.
Yeah, I was reading in the United States.
Yeah.
0.02% of adults have policies like the ones we're talking about. 0.02%.
Right.
So think about that. Like, I can't write all the policies. Everyone wouldn't connect with me. Some people might connect with you that don't connect with me, and vice versa. So there's more than enough to go around. We don't care about that. It's just about teaching you guys and educating so you can do what we've done with these policies.
Yeah. And he works with a different IMO. I actually own my own IMO. And so, from that perspective, we don't work for the same organizations. We represent a lot of the same companies.
You know what I think is funny? IMO, I always think of in my opinion. That's what I always think of.
Independent marketing organization. Yes.
In my opinion.
In my opinion. Yes, exactly. So, all right, guys. Well, I tell you what, that was a lot of information in a very cool window. See why I like to do these lives? Aren't these fun?
Yeah.
Just to like rip it with people and have fun.
We just go on little tangents.
Yeah, totally. So, all right. Any questions, comments? I'll be engaging. So if you're watching the replay of this, definitely comment. If you have any questions, I'll engage with every single one. I'll tag Devin in the video as well. That way he can come in and see it. If you have any questions for him on my channel, if you're on Life 180, go check out Devin. Subscribe to his channel. The link I put in the description below. If you're on Devin's channel, go check me out. But yeah, that's it, man.
Love it.
It was fun. Good times.
See you guys.
All right, guys. Have a blessed, inspirational day. We'll talk soon. Later.